Hello and welcome everyone to our webinar today titled The Election Effect, Separating Political Noise from Market Reality. My name is Justin Brown. I'm the Director of Investments here at Greenspring Advisors, and I'm joined by Pat Collins, our founder and CEO. Pat, thank you for joining us today for this timely and hopefully insightful discussion.
Thanks, Justin. I'm happy to participate. Looks like we have quite a few people that have joined, so happy to have everybody on the call. And there seems to be no shortage of election coverage these days, so we thought we'd throw our 2 cents in this afternoon. So thanks for being here.
Yeah. And on behalf of everyone here at Greenspring Advisors, we want to thank you for your time today and for joining. We hope this discussion is helpful for you as we move into the election next week. Now, before we get started, there's a few housekeeping items I'd like to make you aware of. This webinar is being recorded, and after it concludes, you will receive a recording and a copy of the slides. You will also get a brief survey. We ask that you take a moment to complete this so we can use your feedback to ensure we continue to provide you with valuable and educational content that you want in the future. We received a good bit of questions beforehand, so thank you to those who submitted them. We tried to incorporate many of these questions into our discussion today. If you did not submit a question, but have one now, or one come up during the call, on your screen, you should see a question and answer bubble. As questions arise, you can enter those into the chat, and we will look to answer as many as possible throughout the call today. If we are unable to get to your question on the webinar, then we will do everything we can to circle back with you once the webinar concludes. The last item to note is that throughout today's call, we will be using the poll feature to capture your feedback on the fly. As we use this, you should see a pop-up on your screen that allows you to vote and provide feedback. In the spirit of polls, Pat, why don't you start us off by telling who you're voting for and why?
Well, I thought we were going to keep this call civil, so why don't I maybe just move on to our agenda. But before I do want to kind of just mention one point. I think it's obvious, but we won't be really commenting on all of our political preferences, and we're going to really try to keep this conversation based on data and research. One of our core values is trust the evidence, so we thought we would really stick with what the data tells us about elections and markets moving forward. So with that, why don't we start by looking at what we're going to cover today. So first off, Justin's going to lead us off very briefly with a quick review of where the market stands today, just to kind of set the stage. And but the main goal of the webinar is going to really be around the data and the research that we've done around elections and markets. And there's 3 things here that we want to touch on. The first one you'll see there is pretty obvious. This is not new. We've had years and years of data around elections, and we've had lots of different elections over the years. So I think hopefully people will get some comfort by realizing this isn't new. Second, I think what you're going to find from the research that we're going to show is that we really should not be trying to time the markets based on either what happens in the election or what we think is going to happen in the election. And then the third thing, and you probably heard, if you're a client of Greenspring, you've heard this, probably as long as you've worked with us, is that really staying invested is almost always the best course of action. So we're going to be presenting some information and data around these concepts. So with that, I'm going to turn it over to Justin to kind of cover some of the upfront market performance.
Thanks, Pat. So for a market update, this data is through September 30th, so it captures the first 9 months to start this year. But it's been a very strong start of the year for markets. You see here, all asset classes across stocks and bonds have been positive for the year. On the stock side, all major areas of the market have delivered double-digit returns to investors. The U.S. stock market has led the way, up over 20%. Many of the well-known tech names like NVIDIA, Microsoft, Apple have all driven the market for a good portion of the year. But over recent months, we've seen the market broaden out a bit and continue to do well in all areas and deliver value to investors. Investors that have chosen to stay invested in the market this year and ignore the outside noise around the election and everything else going on have been rewarded for doing so. To put in context how strong of a year it has been for the US market, when looking at US large cap stocks over the last 100 years of data, we have 24 election years to look at, 25 if you count this year. To this point, this is the third best year that the market has seen in an election year. On the bar chart on the left, you can see that the average return in the first 9 months of the election is about 8.2%. So this year's return of 22% really stands out relative to that long-term average. Now the table on the right shows the best 10 years, the best 10 starts to election years. And then how the last 3 months of each of those years played out. Despite how strong each of these years started off, almost every period that we see here also saw positive returns to end the year.
Thanks, Justin. I think this is really interesting. I do want to point out just one item here is that it's really fun to look at this data, but given that we only have about 25 elections, presidential elections that we can kind of look at with real stock market data, I'm not really sure that we should be making a whole lot of major predictions on how to time or get in or out of the market based on that. It's really tough to tell when you look at these years, when there's been a good or bad year, whether it's been because of the election or something totally different or random that really you can't pinpoint. So just really wanted to make sure that we touched on that. But before we move on to the election section, we really wanted to conduct a poll to see how the audience is feeling moving into this election. So Justin's going to flash up on the screen this poll. I want to see, just take a minute if you would to answer it. All right. Thanks, everybody. So I think what we found, interesting enough, is that most people, almost 80% of the people on this webinar are very or mildly concerned about what happens with this election and how it impacts the market. So I think hopefully we're going to alleviate some of those concerns here, but it leads us to our first main theme. So Justin, you mind walking us through this?
Sure, thanks, Pat. The first major takeaway that we had, and this one is somewhat obvious, of course, but I think still important nonetheless, is elections and markets. These are not new things. We have had them for many years, and we have almost 100 years of data to lean on. And I think we can all attest to the fact that this election feels very intense and combative at times. Feels like every time I pull up the Wall Street Journal or read the news or see ads on TV, I'm seeing some sort of advertisement related to the election, often one that is going after the other candidate. While perhaps this is elevated this year, it's certainly not something new. These quotes here on the slide show what the election and political climate looked like either leading up to or just after an election took place. So the first one was back in 2009, right after Obama was elected. Obama's radicalism is killing the Dow. The second one in the middle, a Trump win would sink stocks. What about Clinton? And then the third one, Biden versus Trump. Some speculate that the future of the republic hinges on the outcome of the next election. But for smart investors, it doesn't really matter who wins. So you can see here, all of these quotes are just examples of basically clickbait attempts from the media meant to get you to click the article and to read more. But it's important for us to look at what the actual reality was of the market. While these headlines appear doom and gloom, the reality of the market was much different. During the Obama and Trump presidencies, the market averaged around 16.5% return per year. And during Biden's presidency, almost 11.5% and still counting. So a really strong US stock market across all of these different presidential terms. And I think, at least for me, this is a very stark difference from what you may have anticipated at the time based on those headlines that we were seeing. And it shows the importance of ignoring the noise that you might see out in the media. It's also worth looking at the full history of elections that we have. As I mentioned earlier, we have 24 election years of data to learn from, and this will be the 25th. In all but 4 of those election years, markets have delivered positive returns. This is over 83% of the time there's been an election year, markets have actually been positive that year. And in those 4 years that were negative, I would argue at least that none of those negative years were from the market reacting to the election, but from outside factors. In 1932, for instance, the Great Depression was in full swing. 1940, the outbreak of World War II. In 2000, the dot-com bubble burst. And in 2008, as I'm sure we all remember, the global financial crisis. While there's likely lots of contentious political moments in these election years, as we've seen this year, I think this data helps to show that markets sort of shake this off and have not been overly impacted, as you may think, by it being an election year. Now, Pat, I think a common theme we hear from clients around elections are, well, this time is different. What would you say to someone who's concerned about something like this?
Well, the first thing I'd say is that they're probably right. It is different. Every election cycle is different in some way. So I do think we just have to recognize that. Second, those are often, you'll hear people say those are the most dangerous words in investing, is this time is different, because it typically precludes somebody doing something that maybe is not great as a long-term investor, and they're coming up with some rationale for it. But I guess the main thing I want to talk about around elections and the idea that this is different this time is really around what markets really care about. And markets mostly care about earnings and future expectations, not necessarily who's in office. So will Google's earnings, just to use a company's example, will Google's earnings be materially impacted by who wins this election? The answer is probably no, if you look at the recent history and really the long-term history around markets. So I think that's important to keep in mind when you think this time is different. Yes, politically it may be, but how is it different from the standpoint of markets, I think is something to ask yourself. So just moving on, this is kind of our second theme, which is to not try to time the markets. It's a pretty typical, outside of this time is different. One of the other things we tend to hear is, I'm concerned about, insert your candidate, winning or losing. Maybe I should just stay on the sidelines until that basically happens, until the election kind of is completed. And there's a few things I just want to remind clients with that. So next Wednesday, presumably, we're going to have a new president and new Congress. And my guess is that on Thursday, we're all going to wake up and we're going to go through our normal routine. We're going to go to work. We're going to get in our car. We're going to buy groceries, clothes. We're going to take our planned vacation. Similarly, companies are going to open on Thursday, and they're going to continue to innovate, create new products, and try to create value for their customers. Really, no matter who's in office, companies are going to be formed over the next few years to try to solve some of the greatest problems that we're dealing with in the world. And I guess my point is that whoever's in office has really little impact on the main thing that drives markets long-term, like I talked about before, earnings. Yes, we can and probably will have volatility in the short term, but if we're invested in stocks, we should be prepared for volatility, as that can happen anytime. So I guess the general theme here that I want to just touch on is that companies are going to continue to grow and innovate, and they're going to, by doing so, create wealth for shareholders. And as long as, no matter who's in office, that's not going to change. So Justin, maybe we can start talking about data now. So what data do we have that supports kind of this overall theme?
Thanks, Pat. Those are some great points there. And I think this actually ties nicely into our next theme. But before we move there, I do have another poll for our listeners. So going back to 1926, and hopefully you can see this on your screens, the average monthly return for the S&P 500 is 0.97%. What do you think the average monthly return has been in an election year? So basically, this is taking every single monthly return that we've had that average is 0.97%. And then we're voting on what we think the election months have returned in comparison. I'll give it a few more seconds for everyone to be able to vote there. All right. So the overwhelming majority, 70%, said 1.21%, and I would say about a little over 80% actually thinks it's higher in an election month. And you can see that the correct answer is actually 1.77%. So a normal monthly return is 0.97. In an election month, it's 1.77%. Now, to caveat this is no guarantee by any means or prediction of what next month will bring. But historically speaking, I think it's important to look at and to understand. I think it's an important reminder of the volatility that you discussed, Pat. While markets do tend to be more volatile in election months, that's not an indication that returns will necessarily be bad, just that they may move around a bit more than normal. If you think about stock and bond returns, both are very important parts of portfolios and investment designs. But stocks are known to have a bit more risk and more volatility, but they're also given more potential for higher returns than bonds in most cases. We see this theme play out right here in the data. While volatility in election months is elevated, that's actually resulted in higher returns. This will not always be the case, and I think that's important to note that volatility does not always equal return, but it's just an important point to call out nonetheless that high volatility does not necessarily just mean that things are bad. It just means there's more movement around. Let's move into the next slide to look at this more in depth. So this chart right here might be my favorite one to support why we should not be making our investment decisions based on who wins the election. It's definitely a busy chart, but please bear with me. I'll walk you through it. What we're looking at here are monthly returns for the S&P 500 index going all the way back to 1926. So 100 years of data. It shows the frequency of monthly returns expressed in 1% increments all the way up until midway this year. Each horizontal dash represents 1 month, and each vertical bar shows the cumulative number of months for which returns were within a given 1% range. The blue and red horizontal lines represent months where a presidential election was held, with blue meaning a Democratic candidate won and red meaning a Republican won. This graphic illustrates that election month returns are well within the typical range of what we see on a monthly basis in the stock market, regardless of which party won the election. So basically, there's no trend one way or the other that would suggest one party is better or worse off for investors. The last thing that this slide highlights are the two big numbers on the right, not even considering election versus non-election months. If you looked at every single monthly return over the years, 63% of the time, returns were positive. And that's just on a monthly basis. If you were to lengthen that history, the longer time you're in the market, the more likely that those returns will be positive, and that data is consistent throughout each way that we will break it down. And then, as we mentioned earlier, the average monthly return is 0.97%. Now, this is just one asset class, and we used it because it gives us history going all the way back to 1926. But it shows the strength of markets over time and how important just staying invested and riding out any volatility to reap the rewards are for investors in their approach. Pat, before we move to the next slide, perhaps you could jump in here. I'm curious, A, how often clients are concerned and may want to sit out during a singular month or point in time? And B, what are some helpful things that we can do and think about to stay in our seat during times where the market might have more uncertainty than normal?
I think the urge or desire to kind of stay on the sidelines, sit out for some period of time, whether it be around an election or any other type of really period of uncertainty. That's really what this is people are uncertain about what's going to happen in the future. And therefore, I think oftentimes the kind of fight or flight response is we should maybe sit this one out. So I think it is a common thought. I do think that there is one way to think about this, and which makes it really, really hard to do, and why so many people, if you kind of read any pundit, says to invest for the long term. When you get out for any length of time, you have to get two decisions right. You have to get the decision when to get out to be correct, and then you also have to have the decision of when to get back in. And I've been doing this for a long time, about 25 years. And I can count on one hand the people that have been successfully have done that over my career, that I've seen clients actually do that. Because the main reason is, one, again, making a call on getting out. You might get that right. Maybe the market drops. You can see, at least statistically speaking, if you got out, you have a 37% chance of being right, at least in a 1 month period, because you can see 63% of the time the S&P is positive. So we might get that right. But the second thing then is we have to be willing to get back in at therefore a lower price for it to make it work out. Because if we just get out and we wait, yes, it might go down, but at least history tells us it always comes back. So we have to be willing to get back in at another time. And presumably, obviously, the best time would be when the market's at its bottom. That is a really, really tough thing for most investors to do, because it requires an enormous amount of challenge to stomach the volatility. Presumably, you've gotten out because you're worried about the future. That has now come to, in the example where that works out and the market does drop, you've been validated. And now you need to get back in when things look the bleakest, because that's when the market bottoms out and starts to recover. So it is a really, really hard thing to do. Emotions get involved in it. And, Warren Buffett really did say it best. He mentioned in an article that he wrote one time, if you wait for robins, spring will be over. And the idea that if you wait for things to get better, if you wait for the uncertainty to be over, then the market is most likely going to be much higher than where it is today, because, market participants will typically invest prior to that happening. So, evidence does tell us staying invested is a superior strategy. So I think this is a great way to show the impact or lack thereof of elections. How does this look across the entire election year or the year after someone is elected?
Great question. And we have data on this, of course, that shows the impact of stock and bond market performance around elections. So this chart here shows stocks on the left and bonds on the right. The light gray bars are the average calendar year returns across all years. The dark gray bar is the average yearly return during an election year, and the green bar is the average yearly return after an election. So what this shows us is that from a timing standpoint in the election cycle, it doesn't really matter. Election years, as we have seen this year, can do quite well. And we can also take some confidence that the year after an election year has similarly had consistent and strong positive returns. Now, that's certainly no guarantee of what the next year brings, but it helps to show that if it's an election year, the year after an election, or whatever it may be, there's really no difference from a market return standpoint. So while we see a lot of headlines around these times, like we looked at earlier, we just do not see the market behaving differently in any consistent way around elections. But what we do see is over time, markets rewarding investors, whether it's in stocks or bonds. The last thing I wanted to highlight on this topic, I know we already looked at how an election results can impact short-term returns on a monthly basis, but the natural next question is, how does that impact returns over a full presidential term? So I wanted to include something to help show this. What we see here is the average yearly return the S&P has delivered over time and how it compares to returns during full 4-year terms with a Democrat or Republican candidate in the presidential office. The main thing I want to take from this is it does not really matter who's in the Oval Office. Returns have been positive and investors have earned a nice premium on their equity investments from both political parties, close to 10%. Now, you might look at this and say, wow, it looks like Democrats have a better return than Republicans. I know I can say from looking at the full set of data, we've not seen anything that would indicate there's any sort of statistical significance to which party is in office and what the market will do. It really depends on how you slice and dice the data, when you start your time periods. For example, this exhibit right here begins on inauguration day, but the data differs some if you start the period after the winner of the election is announced. Regardless, we wanted to share this for informational purposes, but it seems like this or anything similar that's just strictly comparing returns and presidencies together are more so influenced by noise and outside factors than who's actually the president at the time. But how would you answer that one, Pat? And do you have anything else to add to that?
The only thing I would say here is that I think I could name 5 to 10 other factors that have a larger impact on markets than who's in elected office. So just the general business cycle, inflation, interest rates, valuation ratios, earnings. These are all things they don't care who's in office. They just kind of are part of the general kind of business trend or market trends. Market forces that happen in just a general free market are going to influence these items way more than any politician. So I've often said that politicians take way too much credit when the economy is going well, and they get way too much blame when the economy's going poorly. And that tends to be the case, in every election cycle. But I think that's been the truth when you look at the data. So let's maybe shift now to our last major theme. And we've talked about this idea that maybe clients thinking around the idea of maybe we should just wait or not invest or stay on the sidelines and wait out the election to see how things go, because this time it really does feel different. And I think you probably could make that argument for a lot of elections over time. We have probably a recency bias to the last few, and they've been very contentious. But if you go backwards, you can think about the Vietnam War, really high inflation of the 70s and early 80s. We had recessions during that time. And most recently, 2008, we had just a horrible financial crisis. And that election happened right in the midst of that. So, perhaps the most important and the one that at least we constantly preach is, just staying invested during elections. So Justin, can you walk us through some of the research we've done on the impact of investing for the long term?
Thanks, Pat. Happy to. We often preach staying invested for the long term, as you mentioned, because time and time again, we see examples of the massive amounts of wealth destruction that can happen from sitting on the sidelines. To help illustrate the impact of staying invested long term and not trying to pull your money out, I wanted to tell a story about 3 different investors who made different decisions so we can see how these decisions impacted their outcomes. So investor 1, you see her on the screen. Investor 1 decided to invest $10,000 in the S&P 500 index back in 1950. Investor 1 was hesitant to invest around elections because he was unsure of how it would impact his return. So he sat on the sidelines in cash during election years instead of investing. Fast forward to now, this investor would have just shy of $1 million of that initial $10,000 investment. Not a bad deal, right? Well, then comes investor 2, who is similar to investor 1, but is hesitant to invest in election months and not the entire election year like investor 1. And how did that impact investor 2's outcome? Investor 2 now has almost $2.5 million invested, an average 1.3% more per year in return than investor 1. Now, investor 2 was feeling pretty good until investor 3 rolled around. Investor 3 had luckily met with their financial advisor from Greenspring, who told them to not try to time the market, ignore the noise, and just stay invested over the long term. Investor 3 did exactly that and had over $1 million more than investor 2, and almost 4 times more what investor 1 had. Now, this is just a hypothetical example, of course. It clearly has a long time frame, but the theme is there regardless of how we break it down. No one knows what the next month will bring, what the next year will bring, but what we do know is trying to time the market or sit out at different points is not a successful investment strategy and can be very costly over the long term, as you see here. And the last graph that I'll share today, I think helps to tie everything we discussed together. This just looks at the hypothetical growth of $1 going all the way back to 1926 to now. The red area represents time where there was a Republican president, and blue represents a Democratic president. Over nearly 100 years of data, with many elections and different US presidents and tons of things going on in the market as well, markets have rewarded long-term investors. Over time, we see no identifiable pattern between which political party wins the presidential election and how that will impact the stock market over the coming 4 years. While it can be easy to get caught up in the current political climate and what financial markets could do in the future, the reality is no one knows what will happen. What we do know is that markets have rewarded investors that have stayed the course and stayed invested for the long term, regardless of who is in office.
Great, thanks, Justin. We're kind of at the point now we were going to do some Q&A, and just a reminder that you can submit questions at the bottom of your screen. I believe there's a Q&A button that Justin mentioned. We do have some questions already, and we had a bunch of questions that were submitted earlier. I think a lot of them kind of revolve around some similar themes, but I'll maybe just touch on one that was a comment that we made that I think is a really good question. It states, some of the factors that you cite as such as inflation are the cause of policies of the incumbent president. How do you reconcile that with the contention that who's in office doesn't really matter? It's a great question. I do think that the incumbent president, but also, politicians, you also have to put Congress in there, because most of the things that a president will do has to, that's any meaningful things that revolve around the purse strings have to go through Congress. But what I would say is I think the news highlights the fact that so-and-so is in office, so therefore inflation is high or inflation is low, or housing is good or housing is bad. I think that there's much more nuance to it. And I think the vast majority of the factors affecting things like inflation, interest rates, the housing market, just the general business cycle, these are market forces causing these. So this is the millions and millions of people that are out there in the business world, supply, demand, where we are with inventories. There's so many different things that will impact that. Does the president have an impact on it? Yes, but it's very minor, at least compared to how you would maybe see it if you were to listen to the news about it. So that's just our take. We think that it is important, but it's a minor factor compared to some of the other factors that would impact things like inflation and interest rates specifically. Justin, we had this one question I thought it was interesting, just came in during the webinar. The Dow had a 5-day decline last week, and the news said that the market was concerned about a Trump victory. That's what has me worried. Again, we don't want to get political here, but how do we tie into, maybe any thoughts? I have a few, but any thoughts on how you would reconcile the fact that maybe short-term market movements with, could they be tied to the election?
Thanks, Pat. I think, as you kind of alluded to, the election can have an impact on what the market does, but there's a lot of other factors that are going on. I think in particular for this question, looking at 1 week, 1 point in time, what I would say is if you had that same return and you looked at, 5 to 10 other news sites, you probably would get a different headline. So I think first, it probably depends where the headline's coming from. And that's not to say to where people should view headlines, but I think it's the intent of news is to have people click to read the articles to generate views for each site. I think what we've seen by looking at this data is that over time, markets can kind of shrug off different things. And at this point in the election, it's all speculation really of who's going to win. And I don't think whether it's whoever wrote that article, whatever polling site is out there, whatever, betting site is out there to try to predict the election, the reality is no one knows. And that's kind of what I would say. So I don't know if you have anything to add there, Pat.
You tend to see this whenever the market falls, is that the news is looking for a reason on why. And sometimes it can be somewhat obvious. Other times they're just trying to figure out why. And oftentimes there's not a reason. It's just the market, for whatever reason, is trying to predict where prices are going to go and where stocks and earnings are going to be a year from now. And that could be about the election. That could be around companies giving guidance around their outlook on the economy. It's really hard to say. So I would say anytime someone tells you, here's why the market went up or down today, that probably is only telling a very small portion of the story. It's really, really tough to kind of to base your kind of decisions based on, kind of what the news is saying, why the market went up and down. Another question that came in, I think, is good, especially if there are clients on the line, which I know there are, and I know there's some people that aren't Greenspring clients, but it's a really good question around what's our plan to sustain portfolio values in the event of a dollar or a market collapse. And I have a few thoughts. I'll start on this, and feel free to chime in. I don't think this is an election issue. I just think this is an issue when you're investing in stocks in general, is that you have to be prepared for the market to go down. COVID, the Great Recession, European debt crisis, the tech market collapse. We've had so many instances of markets falling, 10, 20, 30, 50% over the last 25 years or so. So we really do, as investors, have to be prepared for that, outside of even elections. So I do want to touch on a couple things. One is, I think you have to be consistent with or thoughtful about your time horizon. If you need your money in 5 years, you really need to be careful about how you're investing it, because anything can happen over the next 5 years in the stock market. There's a lot of uncertainty around what that return is going to look like. So that's number one. Now, if you said, oh, I'm retiring 5 years from now, or I am retired, I would still think about things as you don't need all of your money within 5 years. You might need a portion of it over the next 5 years, but you still might have some of your money might need to last 10, 20, 30 years. So thinking about how to think about your portfolio and how much of it is really needed in the short term versus maybe mid or long term is important. Anything short or maybe even midterm should not be probably invested in stocks. It should be more in a safer type of investment vehicle. So that's number one. Number two is just your overall feelings around risk. One of the worst things we can do is tell people, well, just stay the course. Look at what all the data says. But people just deep down can't stomach that type of volatility. That's going to be inevitable. So you have to kind of know yourself to a degree. Hopefully, your advisor at Greenspring's kind of helped, determine that tolerance for volatility. But the worst thing that we want to have happen is the markets to fall, which they will at some point, and for people to get scared and sell out. That's kind of where you have the really horrible results or, outcomes. And then the last thing I would say is you have to stay diversified through these cycles. There are going to be periods, based on what's going on in our economy, that there's going to be winners and losers. There could be, foreign stocks could be the winners over the, I'm not predicting that, but that could happen. US stocks might be the losers. You could have real estate really react well in certain environments and poor in others. So you just need to not put all your eggs in one basket. I think it's a common thing we tend to hear. But that's something that I think is worth making sure that there's an adequate amount of diversification in the portfolio. Justin, if you have anything else you want to add there.
Nothing really. I think your last point was pretty much what I was going to say. I think just focusing on building diversified portfolios, making sure that you have balanced risk exposures can help to provide long-term success from an investment standpoint.
Staying on that diversification topic, I want to touch on another question that we got, which I thought was a good one, and it revolved around tariffs. And I see that's coming in on the tariff side with another kind of, we've got it prior to the webinar, and we have some questions on it from attendees. So, kind of the question is what's the impact of tariffs going to be on the market? And again, this one's tough. We don't really know for sure. We've had tariffs for, hundreds of years in the US. So this is not something new. Now, what I would say is that typically with tariffs, you have winners and losers. Let's just maybe use a really basic example. Let's just say we have a US company and a Chinese company, and the Chinese company is they're selling the same products, but the Chinese company is selling their products 10% less in the US because their costs are lower. And let's just say a tariff is imposed on that Chinese company. So what's going to happen? Well, we're going to have, more parity. It makes the U.S. company more competitive, because those tariffs are going to get passed through to the consumer. So, in that case, you're going to have winners, most likely being the US company in that example, and maybe losers being some of the foreign companies or the Chinese company that I mentioned. It can work the other way too, depending on how the tariffs go. A few things though to note. One is that tariffs tend to be inflationary because they drive prices up. So we have to be prepared for that. And I think when you're thinking about these things, it kind of goes back to diversification. If there are policies, if there's things in place, and tariffs is just one small thing, lots of other things, but the portfolio needs to have protection in place to deal with different market environments. If we have a recession, typically risk assets like stocks are going to fall. Do you have protection in your portfolio to be able to handle that? Are there fixed income vehicles, other vehicles that aren't correlated to the stock market? That's really important to have. If there's inflation, what do you have in your portfolio that will protect against that? Typically, you want real assets like stocks, like real estate, because they're going to protect you from an inflationary environment because they're going to participate in it. So I guess I just wanted to kind of mention a thing like tariffs. Yes, it could have an impact. I don't want to say it's a massive impact, but it could have some impact. And it's really important to make sure your portfolio is positioned to be able to deal with, you can't deal with everything all at once. You need to have diversification so that some portion of your portfolio is appreciating in different market environments. Justin, anything there?
Yeah, those are great points, and nothing really to add outside of, I think it feels like every year when there is an election coming up, there's a lot that is talked about when candidates are campaigning, and then versus what actually happens post-election. So obviously everything is different. Some can be done through executive action, some can be done through legislative action, but I think it's an important reminder that what's campaigned on is not always what happens, and that's kind of what I'd like to add.
One other question. I think this is also a really good one to think through. I'm not sure if we have anything solid that we can do yet, but I want to bring this up. So tax policy, there's some questions around that, depending on who wins, what are we looking at from a tax perspective? So I think it's important that everybody understands that the current tax law is set to sunset in 2026. So with that sunsetting means we are going to revert back to what the old tax law was prior to Trump's tax cuts that happened, years ago. So what does that mean? It's similar. There's probably going to be some winners and losers in that type of situation. Broadly speaking, it will be one of the losers, I guess, will be in general tax rates are going to go up. There will be some people that probably won't feel the brunt of it as much. We have a lot of our clients that are listening today in the state of Maryland and New Jersey, high tax states. They were unable to deduct state income taxes for years. That would come back if it sunsets. I think the main thing, though, is to understand is that it doesn't really, it does matter who becomes president next, but that's not enough. This requires legislative action for it not to sunset. So we need Congress to act. And, your guess is good in mine as whether or not that's going to happen or not. But I do think that it's something we have to be prepared for, is potentially higher taxes. And so thinking through how do you structure your portfolio for it to be tax efficient if we see higher rates is going to be a really important discussion, conversation to have. And it also will be around tax planning, just not even outside the portfolio. Now, all of a sudden, we're going to have a whole new set of tools to be dealing with and guidelines. And, your advisor really will be up to speed on that. But that's something that will need to be discussed because it could have an impact on how you file and, how you approach tax planning. Let's see here. A good question. We were referencing the S&P the entire webinar, and obviously we did that because we're talking about U.S. elections. But one of the questions was around the idea that, well, why does the S&P in my portfolio kind of deviate as far as why am I getting a different return if I look at my portfolio over the course of a month Why am I getting a different return than what the S&P is generating? Justin, any thoughts there? I have a few, but maybe I'll turn it over to you, see if you have any thoughts.
Yeah, so I'd say first, to the point that you hit on, S&P was used because it's elections in the US that we're kind of discussing here. Obviously, the S&P 500 is not the entire investable market in the US, and how we think about investing here at Greenspring is we think it's very important to have diversified exposure across large, mid, and small caps. But the reason we used it is because we have history going back to 1926. A lot of the indices might not have as frequent of history available, so we wanted to have a longer time frame to look at. And then I think part of the question was how portfolio performance can relate to the S&P, and that's really based on diversification. I think if you were solely invested in the S&P, you may have done well recently, but there's periods throughout history that we look at. I think about from 2000 to 2010, where if you were solely in the S&P 500, you'd be flat to negative from a return standpoint for an entire decade. But it's important when you design portfolios to have exposure to other asset classes. So if the US market specifically does not do well, you have ballast in your portfolio coming from international markets, coming from potentially real estate or bonds. I think it's why we build diversified portfolios. So it's really two things. We use the index oftentimes here because of the additional history, but when looking and thinking about portfolio performance, I think the indices that you might see online or in the news are often the S&P, the NASDAQ, or the Dow. I think all of those have sort of their own flaws to view portfolio performance on solely against. And it's kind of because of that diversification that your portfolio needs to have. And that's why it will differ.
I think the term I've heard that I like to use is that if you're properly diversified, you're always going to have something to complain about, because things are going to kind of zig when other things are zagging. And so if you compare your portfolio to the S&P, which is a pretty standard index in the US, almost anything else you invested in over the last 10 years is going to underperform the S&P, whether it be bonds, international stocks, real estate. There's just, you name it, S&P has been the best performer. So if you have any diversification in your portfolio, you're going to probably be a little disappointed over the past few years. But as Justin mentioned, it wasn't long ago, the beginning of 2000, where if you had been invested 100% in the S&P, you would have lost 30% of your capital over a 10-year stretch from 2000 to the end of 2010. That for most of our clients is an unacceptable kind of result over what we would consider a long-term time horizon. And so anyways, that's why we do it, is to make sure we don't put all our eggs in one basket, because whatever that basket is, it has the potential to go down. The last thing I just mentioned on the S&P is it's 500 stocks in the US. Our portfolios typically at Greenspring have about 12,000 stocks in them. So it is it's still a very large component of what we do. But there's other investments that we have in the portfolio, at least in the equity universe. So that's why you probably see a little bit of a divergence. We did get one question on the housing market. So basically, how does the election impact the housing market? Justin, any thoughts there?
I would say in the immediate term, it probably doesn't. Certainly, there's policies that have been proposed by each candidate that might impact the housing market. But I think it's worth, again, noting that policies proposed versus things actually happening often require legislative action and agreement from Congress and the president themselves. That's kind of the main thing I'll say on that. I don't know if you have anything else, Pat, that you'd like to add.
Similar thoughts. I think it has very little impact on the housing market. It's similar to kind of what we talked about earlier, that market forces have the biggest impact on the housing market. So mortgage rates, supply and demand, job growth, all those types of things. I know a lot of times people want to put that on our politicians, that they're the ones who dictate that, but really it's the market and it's the economy that decides what mortgage rates should be. Even the Fed doesn't impact mortgage rates, really. They impact the very short end of what banks lend at each other overnight, but they do not have a real strong impact on what the 30-year mortgage rate is. So with that being said, I think the short answer is probably very little as far as what goes on with housing, depending, based on who's in office here. I know we're coming up on time. Anything else? I think there's just one thing we want to kind of leave people with. So I would just mention kind of as we wrap up, I know there's a lot of clients that are on the call here. If you want to learn more about how your portfolio is positioned, we talked about weathering any type of storm we may see. I'd suggest reaching out to your advisor to set up a time to chat to make sure you understand why we own each thing in the portfolio. It's for these reasons of what if we have a downturn? What if things really do well over the next 5 years? And I'd say if you're not working with Greenspring and you're on the call, we'd like to offer you a complimentary second opinion on your portfolio. If you're unsure why you own things, or if the portfolio is positioned to protect you against different market environments like high inflation or recession, just feel free to reach out to us. You can go to greenspringadvisors.com, click on contact us. We have a calendar there. You can just set up a time right there to talk with one of our advisors. So thank you everybody for participating on the webinar. We hope it was helpful, and reach out to us if you have any questions.
Thanks, everyone.